We would like to measure the liquidity of a company, corporate liquidity. Liquidity is a measure of risk. It is defined as the ability of a company to repay its short-term liabilities as they come due. It's an important risky measurement. If a company is not able to repay its short-term debt, then it may not be able also to pay the long-term liabilities. Question is, how can we calculate the liquidity of a given company? We take an accounting approach to measure liquidity. It's called static measurement of corporate liquidity. The model used is current ratio. Using data from the balance sheet of the company, total current assets and total current liabilities, we can calculate the current ratio of the company in any given year. For example, we want to calculate the current ratio of PCP for the year 2023 and 2022. From the balance sheet, we see that the company total current assets is 121 billion and 111 billion for the year 2022. We take also the total current liabilities, 87 billion and 47 billion. Using the formula shown above, we divide the total current assets by the total current liabilities. We get 1.39 for the year 2023 and 2.33 for the year 2022. It's a multiple figure, it's not a percentage. 2.33 for the year 2022 and 1.39 for the year 2023. What do these figures tell us about the liquidity of the company? First, when you compare the current ratio of the 2 years, we see that the ratio for the year 2023 is lower than the ratio of 2022, meaning the company's ability to repay short-term liabilities in 2023 is lower than the year 2022. From there, we see the declining trend of the ability to repay debt of the company. The number shows that for every $1 of current liabilities, the company holds $1.39. So 1.39 is greater than 1, so it can pay. 1.39 can repay $1 of current liability. The company, as if the ratio is greater than 1, it means the company has the ability or current resources to repay the liabilities. Current ratio is a static measure of corporate liquidity. It's usually interpreted as current ratio greater than 1 indicates good liquidity position, because the total current asset amount, the numerator of the formula, is greater or exceeds the current liability. Although current ratio or the static method is quite easy to calculate, it is broad measurement of liquidity and it's not useful for operating managers, because the operating managers actually directly affect their company's liquidity in their day-to-day activities. Operational managers or operating managers are managers that control the marketing activities of the company, the production and distribution activities, purchasing activities. These managers actually make decisions that directly affect the current assets of the company, the operations of the company, and therefore the liquidity of the company. So their actions are not directly related to the current ratio. So current ratio as a measure of liquidity is an accounting approach. And as such, it has limitations because the balance sheet data is historical values. And the ratio we use, current assets divided by current liability, does not consider all the other variables, long-term assets, long-term liabilities, and equity of the balance sheet. So we have there two limitations. One, values shown on the balance sheet are book values, they are historical values. And current ratio does not consider all the other components of the balance sheet. It also makes an assumption that inventories are liquid assets, account receivables are also liquid, that customers will pay the amount to the company, and the company will convert the inventory and account receivable into cash, and then use that cash to repay the liabilities.